confusion on the tariff front. It's quite strange, good but true that markets are holding on. Why is that?
Right. And it is a phenomenon all across Asia. If you look at the Asian markets in the first half, they have moved up about 13 to 14%. They have climbed several walls of worry. I think, it is a bit strange, no doubt. And I personally think that there is a degree of, I mean, if I may use that word, complacence on the part of investors about the potential impact of tariffs and more broadly about the potential impact of policy uncertainty. I mean, think about it. If you think today, the tariffs on China are more than 50%, and therefore you decide to relocate your supply chain, your manufacturing capacity into a low tariff jurisdiction. But tomorrow, that situation is reversed, and tariffs in China decline, and in the other country it increases. Then in this kind of a scenario, it's impossible for any manufacturer or any business to plan ahead. And I think we have not yet seen the impact of that. So, my conclusion out of all this, it would be that, okay, we have seen a very good first half. The second half is where we have to tighten our belts and we have to sort of brace for a more modest returns, maybe single digits, all across Asia. I'm not singling out any market here. Some teams are doing well. AI is again back in focus, particularly the likes of NVIDIA and the entire AI supply chain. I think consumption, private domestic consumption in some markets are being supported, are being boosted, like in China, like in India. So there are some of these themes which investors would have to cherry pick, and within these themes, the stocks, the companies that have assured growth and relatively better palatable valuations. And so it will be a very interesting stock pickers market going forward.
But Manishi, it's always a stock pickers market, isn't it? I mean, you always have to focus on individual businesses rather than macros or micros. So my question is that what would be different? Because last 1 year it's been a stock pickers market only.
Right. Well, I mean, if you simply put your money in an ETF based on MSCI Asia X Japan, this year you would have made pretty decent returns. In 2025, you would have made about 14%, in US dollar terms. And that is not bad returns by any means. So even if you did not do stock picking, you put in a low cost index ETF, and an Asia-wide ETF, then well, you were quite okay. You would have been well off. But that situation, I don't think, would not last going forward. Some of the reasons I provided, I mean, the market would have to sort of appreciate that there are some companies who would, who would possibly ride through this period of uncertainty much better than others. There are the market leaders in each segment who would possibly have the ability to, pass on cost increases and, despite that, retain their customers. So I think those are the parameters that investors would have to look at.
Absolutely. I hear you there, Manisha. But one thing is absolutely clear that Indian markets have made a peace with the contingent scenarios in the global front. But we can't even negate the fact that we need a trigger, an economic indicative action to move ahead. And yes, earnings estimates, trajectory, currencies are a few triggers which can give that boost to the markets. Considering the earnings trajectory and remembering the operational updates which we have seen in past, what do you think? How is the earnings season going to pan out this time?
Now, that's an interesting question because somewhat disappointingly, in India, we have seen earnings estimates decline from last summer, actually, from around August, September last year. And almost each and every sector has been a victim of this. Earnings estimates have declined across sectors on a broad-based basis. In fact, if you look at whole of Asia, there are just two markets, Korea and Taiwan, which have seen earnings estimates increase in a sustainable manner. Um, Now, there is, of course, kind of a point of view, and I kind of partly tend to agree with that, that earnings estimate trajectory in India would bottom out in the second half of this year, possibly in the fourth quarter, and begin to move up, driven by a few variables. Number one, the additional cash that has been put in the hands of taxpayers, and there are more coming as far as the government workers are concerned, that will begin to have an impact on urban consumption at some point of time. Number two, this jumbo rate cut from the Reserve Bank of India, the cut to CRR, will begin to have an effect on liquidity and consumption and investments with a time lag. The monsoon seems to be good. Therefore, we don't have much of a concern about food inflation and even rural incomes. So I would think that, those would be some of the triggers when investors actually begin to see that earnings estimate upgrades are beginning to come through. That is when, I think the market would begin to move up on a sustainable basis. Before that, what India is going through is a classic time correction, which is actually not a bad outcome because the relative valuations in the process are correcting. Just see today, I mean, Hong Kong is up 1.4%, Taiwan is up 0.3% roughly. I can see it on my screen here. And India is just about flattish to 0.2, 0.3% down, which is that same classic time correction which is happening. And that's a good outcome because the relative valuations are correcting. If it goes on for somewhat longer, the valuations would again begin to look attractive to the foreign institutional investors.
Where are you on this India versus China trade or China versus India trade?
These two markets actually are, they're characteristically different. I think China is essentially a trader's market. I mean, there are some themes that you have to play for a relatively short period of time. Also, one has to be mindful of the fact that in China, even the themes that are, leading to very strong top line growth for companies, they may not be really money making for the companies because of the intense domestic competition that every company faces over there. We have seen, unbelievable degree of price cuts in the electric vehicle segment led by the market leader, BYD. We have seen even in food delivery, the companies like Meituan, JD.com, and there are new entrants coming in almost every day, and they're driving the prices down for their services. These are very high growth sectors in China, but you don't really have increasing profitability there. I think this is something that characteristically differentiates the Indian market from the Chinese market. There are structural drivers there. So you can make money over the long term. If you look at last 20, 25 years, even the broad top line indices have generated about 14 to 15% CAGR, and that's astonishing. Right. So, I think it's basically it depends on, the investor's attitude and on his time horizon. And, that is over the longer term, I think India is clearly in a superior bracket.
The dollar index has fallen from 105 to 97.
Mm-hmm.
If it starts recovering again, what could be the implications of that for emerging markets? Because we are taking, in Jan we took long dollar for granted, now we're taking short dollar for granted.
Right. No, that's a very interesting point. So yes, the dollar has declined. It has been a great tailwind for emerging markets. Whenever you have emerging market currencies appreciating vis-a-vis the US dollar, you have flows coming in. And that's exactly what we have seen over the past 3 months or so. Now, there's one point I would like to make. Obviously, currencies would fluctuate. We have seen a sharp decline in the dollar, so it may, for the time being, kind of stabilize here, may even move up. But if you look at the longer term, the dollar has clear appreciation and depreciation cycles. If you look at the last 50 years, on an average, these move in 7 to 10-year ranges. The last cycle, the dollar appreciation cycle, has now been 13 years. For the last 13 years, right from around 2011 or 12, the dollar has been appreciating. And if you look at the real effective exchange rate, that would tell you that the dollar is overvalued to the tune of almost 25 to 30%. So what we have seen, this 8 to 10% decline, is just the tip of the iceberg. If the dollar has to come back to a sort of a fair value, it can actually go down maybe another 10 to 15%.
Manish, when you say it's a stock pickers market, but another concern is the sectoral churning. I mean, it is impossible, hardly impossible to figure out a theme because there's so much of sectoral churning, and one cannot pick a theme at this point in time. And another concern is the FIs and the DIs. Now, the DIs are trying a lot to support the markets, but at the same time, the FIs are not really making the comeback. Of course, we see the buying figures, but the quantums are very short. Is it a mid-year vacation which the FIs are on?
Yeah, you're right about that point. That, I think, the kind of conversations that we have, the FII sentiment on India has improved, especially in this situation of trade uncertainty where the negotiations are going on between the trade partners. I think investors are appreciating that India is in sort of a semi-sweet spot, if I may use that phrase. It's not really an export-dependent economy. It's not really sort of in that bracket, like in many of the ASEAN markets, where it is a large, trans-shipper of Chinese goods. So many of these, very strong friction points that exist between the United States and some of the other trade partners don't really exist for India. At the same time, despite this sentiment about India having improved, we are not really seeing that avalanche of money coming back. One of the reasons for that are fundamentals and valuation vis-a-vis the fundamentals. So India remains expensive, as it should. But if you look at last, say, 15, 20 years average, Indian P valuation multiple used to be at a 40% premium to Asia ex Japan. Now it's at 55%, somewhere between 53 to 55%. So while, the FIIs acknowledge that India, because of the higher return ratios, should trade at a premium, they're questioning what should be the quantum of that premium. And I think, once we have a bout of time correction, the market is being held up by the domestic money. But once we have a bout of the time correction, the valuations look palatable again, and earnings estimates begin to move up. They bottom out and begin to move up. That is when the real FII interest would come back.
All right, Manishi, with this, would like to thank you for taking the time out and speaking with us and giving us your view on the markets and where are we headed from here on as per you.